reporting. All right, so we're going to start with unearned revenue today, January 28th. Happy Friday. All right, so we have a situation where you're lucky enough that your customers pay you in advance. And not very many customers are willing to do that because they want to make sure that you provide the service. Although I have a question, has anybody ordered stuff online and they say it's not ready yet, but go ahead and place the order? Has anybody done that in the last couple months? I have
like
not.
A pre-order?
No, not a pre-order, Cole, where you go online and let me give you an example. I wanted to buy a pair of shoes and they didn't have my size and the color I wanted. And they said, go ahead and place the order and we'll ship it when it comes in. You know, the whole supply chain issues. So my question is, I didn't order. I was hesitant to order. So I waited. But I'm wondering, do they charge your credit card when you place the order, or do they wait? I don't know. But that would be an example of where they would charge you ahead of time and deliver in the future. Okay. As a customer, I'm not willing to do that. I might have to because I really want these shoes, but we shall see. All right. So revenues received before the company delivers goods or services or provides. So we can't really call it revenue. Let's say cash received, cash that is received, advance payments of cash before the company delivers the goods or provides the services. Okay, so company gets cash, cash goes up with a debit. And then what's the other half of this journal entry? The other half is that they owe something to the customer. They owe, if I had ordered the shoes, Nordstrom would owe me the shoes, the product. If it's a question of, I want you to repair my, a good example of this is attorneys. They always charge you ahead of time. They want a $5,000 retainer. So they debit cash and they credit unearned revenue because they haven't provided the service yet. Okay. So the company owes the customer the service. It's a liability, and the name of that liability is unearned revenue. Okay. So the classic examples of this, of course, I didn't put the law firm up, the lawyer up, but the classic examples of this are season tickets, airline tickets, anything you buy on Expedia, because when you pay for a trip, you pay in advance. It's not revenue to Alaska Airlines. It's not revenue to Expedia until you take the trip. A magazine subscription, usually it's a one-year subscription. Of course, insurance, any kind of cruise or vacation. I've never been on a cruise in my life, but you do have to pay in advance. Okay. And by the way, if you like cruises, they really have good deals now. I'm always kind of nervous lately with COVID, but all right. So let's go to the top of page 46 in our course pack. And I want you to think this out. And in the chat, give me the journal entry for this problem. Assume that Seattle Mariners sells 100 season ticket baseball games at $1,782 per ticket for its 81 game home schedule. What is the entry the Mariners make to record the sale of the season tickets? What is the entry the Mariners make to record the sale of the season tickets? So put the answer in the chat. And I'm just going to check the course pack really quick here because I think on 45 I had a So Helena, I'm asking to correct that entry to match it to the list on the middle of page 45. So, okay. Because my PowerPoint had an error in it on Wednesday. Julie, you are correct. Bryce, you are correct. Bryce, give me the dollars. Peter, you're correct. Okay, so, all right. So 1782 times 100, they get $178,200 in cash, and the unearned revenue is 178,200. Okay. Okay, I want to stop here. I want to go back to your course pack real quick. I want to make sure we have this correction in for everybody. Okay, so in class on Wednesday, I had an error on my PowerPoints. So look at page 45, middle of the page right here. This is what the journal entry should be for the additional taxes. Okay, so 7650, 800, 5400. Okay, so let's just quickly go back and look at that journal entry. I corrected it here, but I think on Wednesday my numbers were different. So correct your journal entry in the bottom of page 45 and make sure it's 800, not 600, 850, not 650. Okay. Yeah. All right. Okay. So let's go back. Let's go back to 46. Now, the first time I learned about this, I was at a local conference for accounting teachers, and we had a guest speaker who had worked in the accounting department of not the Mariners, but not the Mariners, but the Seattle Supersonics. Can you believe that? That was a long time ago. Okay. And she was explaining how they account for the season ticket sales. So that was kind of a fun example. So I used to put up the Sonics here, but I had to change it to the Mariners. But anyway, so they play a lot of games, and they don't, anyway, I'm not going to go there. At the end of the first month of games, April, the Mariners played 13 home games. Okay, so they can recognize revenue now on April 30th, and most companies publish financial statements once a month. We always do it once a year or twice a year in class, just because it gets too much tedious work. But at the end of the month, they want to recognize those 13 games. So give me the journal entry to recognize those games. Just the 13. So see if you can come up with that in your course pack. What is the journal entry for the recognizing revenue? And I didn't give you a year, so I'm just going to say, all right, Rose, you are correct, but give me the dollar amount, Rose. Helena, I'm interested in how you got that number. My number is slightly different. Julie, you're correct. Micah, give me a specific, that's correct, Micah, but give me a specific revenue account. Same with you, Peter. Peter, your dollars are correct. So, and your sales would be if you sold product. Be more specific. It's your company. You own the Mariners. What kind of revenue account are you going to name it? Peter, ticket revenue. Yeah, could call it that. Okay, so Helena, how'd you get your number? Did I make a mistake? I don't think I did, but
I got that same number.
You got it too? Okay. Okay. 178,200 divided by 81 games. 2,200 times 13. Yeah, okay. All right. So I named it ticket revenue. You could give it a different name. You could call it season ticket revenue. I want you to visualize a financial statement for the Mariners, and they have ticket revenue. They have other sources of revenue, but they could even be more specific about the ticket revenue. They could have an account called season ticket revenue, and they could have an account called single ticket revenue, where somebody like me goes and wants to see a game once or twice a season. Okay. But they've just lumped it all into ticket revenue, or I'm suggesting they. So if you have room on page 46, just squeeze in a T account for unearned revenue and put that first journal entry in there that we booked, 178,200. And then and that would have been whenever they sold it. And I didn't give you a date for that. Let's say it was January. And then later on at the end of April, they're saying we're going to recognize 28,600. Their balance is 149,600. Yep, that's correct. 149,600. And that's the remaining games that they have left to play, which is 68 games left, also at $2,200 a game. Okay. All right. And that's how unearned revenue works. So as part of kind of a check, if your company has unearned revenue accounts at the end of every month, or however often you play, however often you create financial statements, you have to look at those accounts and say, now, is there any revenue that we've earned up till now? Because we always want to recognize all the revenue. Okay. All right. And the other source of revenue for the Mariners could be merchandise, could be if they run restaurants, they have the Mariners shop in the, what stadium are they in? I forgot. Is it Safeco?
T-Mobile.
Oh, it's called T-Mobile now. They keep changing names. In T-Mobile, if they run a merchandise shop, they're going to have merchandise revenue. If they're doing food booths, they have all the food shops there. If they have a Mariners food shop, they're going to recognize food revenue, alcohol revenue, the whole 9 yards. Okay, the whole thing. Okay, so that is unearned revenue. The other current liability is current maturities of long-term debt. And so if you have a loan for $100,000 and every year you pay back $20,000, in your financial statements, you would put current portion of long-term debt, 20,000, long-term debt, 80,000. Okay, but there's no journal entry that we make. It's just a question of looking at that long-term debt and saying, is anything due in the next year of the principal? Of course, any interest on your long-term debt, it's going to be due every year. So it's always going to, interest payable is always going to be a current liability. Okay, we're not doing journal entries on warranties, but I want you to understand that that's also a liability, and companies must estimate their liability for warranties. So it's sort of similar to estimating bad debts that we did in Chapter 8, where we say, okay, we're going to sell this product. How much of this product is going to come back that we are going to have to replace or even refund? Okay, so warranties, in my opinion, are getting way too short. Any kind of electronics, it seems like the warranties like 60 or 90 days these days. It used to be 1 year, 2 year, 5 years, but with technology, it seems to be a lot shorter. So they set up a warranty payable account, and then when the customer returns product, the cost of the replacement product, not the retail price, but the actual cost, is charged to the warranty account. And hopefully they've estimated correctly. So let's take an example in our heads. I don't have a slide for it, but let's say that a company has sold a product with retail sales of $70,000, but the cost of the sales was only like $40,000. And then they say, this is what they have to say, what percent are going to be defective? What percent are going to come back to the store? Is it 1%? Is it 5%? Is it as much as 10%? And then they make a journal entry, warranty expense and warranty payable. Okay, warranty liability. And then they use that liability like a reserve account. Okay. All right. Bottom of page 46. I don't know why they stuck this ratio in the chapter. This should be super familiar to you guys, but because it's current, because we're looking at current liabilities, this is the ratio we work with. So working capital is the difference between current assets and current liabilities. And of course, liquidity refers to paying short-term debts and unexpected needs for cash. Okay. Current ratio is current assets divided by current liabilities. And the biggest mistake that people make with this ratio is they use total assets and total liabilities. It's not. The formula is in the name. It's just the current assets and the current liabilities. Okay, so we have 20,856 in current assets, 16,210 current liabilities. We have a current ratio of 1.29. And it's saying for every dollar of current liabilities, we have $1.29 of current assets. Okay. All right. So that ends section 1, and we're not going to start bonds yet. So that'll be in our next module. But let me close down chapter 10. And let's go in your course packs. We're going to slip over to Appendix G. And I just want to introduce time value of money. All right, and this will take us way over to page, we're going to slip past all these bonds pages and go all the way to page 66 in your course pack, please. Page 66. I have a lot on bonds. So it looks like this. Appendix G, back of textbook. Okay. I want to know what you guys know about time value of money. What do you know about time value? Anything? Have you studied it before?
I don't really know anything about it.
Thank you, Cole. Anybody else? You all know about it? Not really? No? Who else?
Not really.
Not really?
Isn't it more valuable to hold on to money? Like if you have to pay a bill, to hold on to like one of the last days, because then you can be earning interest on it potentially, or be saving it for other things if you need.
Exactly. That's exactly it. And what kind of a bill are we talking about? Are we talking about a monthly bill or another kind of bill?
I mean, either one, it's usually going to be more helpful for like long term on like notes due if it's due like every year or something like that, because you're not going to earn a ton of interest on like a monthly, just having it in your account.
So it's the theory of time affecting the value of money is all contingent on interest. And interest is a Western concept. I just want to say that there are different cultures with different attitudes about interest. Okay. There is a lot of strong feeling in a lot of cultures that interest should never, ever be charged. Okay. So we have to be mindful of that as well. But I want to show you how interest works and how it increases the value of the money. Okay. So I've got some questions on page 66 in your chat. Please tell me, would you rather receive $500 now or in 10 years from now? Just put now or 10. But if you got it now, you'd spend it. And then in 10 years, you wouldn't have it. You're all saying
I would
you
invest it.
Sorry? Are you going
I
to
would
invest
invest
it?
it. Yeah.
You would invest it. All right. True story. True story. Okay. A grandmother and grandfather wanted to give each of their grandchildren a little bit of money for college. This would have been 25 years ago. Okay. So they figured out that the price of college was about, okay, what do you think the price of college was 25 years ago? Per year. University of Washington.
15 to 20,000?
Per year, Cole. 15 to 20?
Yeah, 15 to 20,000.
I think that's what it is now. Let's see.
I thought it was like 40,000 now. UW?
Okay. Here we go. Room and board, if you count that. So that's 30,000 now. And that is counting, but here's your tuition, 10,927. Okay. So about $15,000 in tuition, and then books and everything else is about 15,000. So now, in your mind, Cole, were you including the cost of residency?
Yeah.
Okay, so that's okay. So let's say we include the cost of residency, it's $30,900, okay, now. And you're saying it would have been 15,000 25 years ago, correct?
Right.
Okay, anybody else? Any other guesses? 25 years ago, cost of college.
I'm saying about from 5 to 10,000.
Peter, you are correct. Okay, so tuition cost about tuition and books and everything cost about 4,000. So whatever the dorms and all of that costs. So say another 4,000. So about 8,000, $7,000 or $8,000. Okay. So that gives you an idea of what life was like.
That's some serious inflation.
The next time somebody tells you you're lazy because you don't want to work and go to school, tell them you couldn't possibly work and cover 30,000 a year. So, and that when they went to school, college didn't cost as much as it does now. So anyway, that's another topic that I feel strongly about. So the grandparents said, we want to help with college. We know it's about 8,000 a year, including room and board, you know, the dorms and all that. We will give each of our grandchildren 4,000 a year for college, for a total of $20,000. Okay. And that will cover half of the price of the college, and the parents can pay the other half if they're able, or the kids can work. Okay. Well, there were 6 kids in that family, and the first kids were born and ready for college 25 years ago. The second kids were born and were ready for college 10 years ago. No. Yeah, 10 years ago. Okay. So the grandparents who wanted to be fair gave all of their grandkids at the point they went to college $20,000. Was that fair? So let's say, I can't do math on the fly. So today is 2022. The first kids went to college in 1997. The second kids went to college in 2013. Okay. 1997, here's $20,000 to go to college. 2013, here's $20,000 to go to college. We have been fair with our grandchildren. Was it fair? Oh, I got 11 new messages. I'm not looking at the chat right. No, 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 no. It was nice, but not fair. Yes, it was nice. Oh, $75. Woo! Depends on what college now and invest. Yeah, absolutely. Actually, they did change it and raised it, I think, to 30,000, which helped a lot, but it was still not quite the same amount of money. But that's what time value of money does. It's taking into account inflation, okay? So it's a function of interest, time, and money, all right? So the same amount of money, and this is kind of a hard concept, is worth more today than it is in the future, okay? The same amount of money. So back in 1997, 20,000 could buy a lot more college than it can in 2013. Okay. Because as I think Jared or who said it, you can take that money and invest it back in, if we had all gotten $20,000, then you could invest it. And then how is interest calculated? All right. So let's do one or two problems on simple and then compound interest. Okay. We'll do page 70 in our course pack. So turn to page 70. So there's different types of interest. Appendix G is all about something called compound interest. And let's walk through the calculations, but we'll start with simple interest as a comparison. So you have to have something called principal, and we're looking in your course pack. You have to have interest and you have to have time. So we're saying you borrow $5,000 for 2 years at 12%. In the course pack, how much interest is earned the first year? How much interest is earned the second year? So give me two answers separated by a comma. How much interest is earned? And this is simple interest, so makes it pretty easy. So how much interest is earned the first year? How much interest is earned the second year? You borrowed $5,000 at 12%. Interest is always expressed annually. How much is, Rose, you are correct. And how much for the second year, Rose? Julie, you're doing compound interest. This is simple interest. Katya, you're correct. What's the second year? Rose, you are correct. So first year you earn $600 of interest. I'm sorry, first year you owe $600 of interest. And because we're doing simple interest, we're always just going back to the principal and saying 5,000 times 12%. Bryce, you're doing compound interest. We're doing simple. We're going to do compound at the bottom of the page. So the second year we owe $600 for a total of $1,200, and then we'll pay back $6,200. Most people understand simple interest. Okay, so let's do another one with simple interest. I do not have a space for it in your course pack, so just squeeze it in on the top half of your course pack. You borrow 1,000 for 3 years at 9%. How much interest is earned each year? Zachary, you're correct. Zachary, you're correct. Again, it's simple interest. Rose, you're correct. Cole, correct. Okay, yep. So very simple. Okay, all right, we're done with simple interest. We don't do simple interest. We do compound interest. Okay, so.
Yeah, I don't think, do any loan companies do simple interest?
Nope, none that I know of. Maybe if you borrow money from family, they'll do simple interest.
Right.
Okay, so compound interest. So let's go to the, let me show you the example here. Okay. Did I do the 5,000? I meant to do the 5,000 one. Nope, I didn't do the 5,000. Okay, we'll come back to that. All right. Same problem, but compounded every year. So how compound interest works is year one. So think of a timeline with milestones for year one, year two, year three. At the end of year three, you pay back the loan. Okay. So you haven't paid anything back for the whole 3 years. If you paid the interest, anyway, hold on. If you paid the interest every year, you'd still do simple interest. But because you haven't paid the interest back, that interest that you owe gets added to your loan. you still owe this money. Okay, so year one goes by, it's the end of year one, your interest owed is $90. Okay, but year two, that 9% interest rate is no longer applied to the principal. It's applied to the principal and year one interest, which is now 1,090 times 9%. Year three, you add both of these together, $90 plus 98.10, and you say, I now owe on my loan $1,188.10, and I'm borrowing it for that third year, 9%, and I owe $106.93 for year three. Add those three interests up and you get $295.03. Ending balance that you have to pay back on your loan is $1,295.03. All right. Okay, now I think we have to stop because I want to send you into your breakout rooms. So on Monday, we're going to talk about how nobody in their right mind would do these calculations, and we're going to use the tables to do the calculations. Okay, stop sharing. Stop sharing, go here. And go to your teams. Project group. So I'm gonna send you into your breakout rooms. And I want you to, if you have any questions, I will stick around a little bit. I mean, I'll come into your breakout rooms. If you have any questions, I want to about your financial statements, which are due tonight. So be sure to ask me. So remember your groups, and I'm going to set up breakout rooms. So what I want you to do in your breakout rooms is pull up the project on your computers and look at the contract. You do not have to assign roles now, but I want you to fill out the first part of the contract. It's not due until next week, but the first part of the contract, I want you to decide who's going to submit the contract. I want you to decide who's going to be a team leader for your project, and then start filling out that first part of your contract, your availability, your oh, let's bring it up. Just go ahead and bring it up. So what's your availability? Take me off of here. Contact information, and then where, when, and how are you guys going to meet? Set up your meeting times, get rid of my blue, get rid of my examples, and what are you going to do? And then next week, you'll start working with this. Who's doing what part of the project, okay?
So we're going back to in-person classes on the 7th, right?
That is correct. And I didn't go over that announcement, but yes, we are returning to campus, not next week, but the week after, the 7th. And part of the class on the 7th will be, we'll proceed on with chapter 10, but the second half of class will be a test review for chapter 8 and 9. And we will have the exam on February 9th, Wednesday, okay? All right. I'm opening up the rooms and you guys should be good to go. So fill out that first part of your contract. Just pick a leader and pick who's going to submit it and start working on that. And then I'll pop into the rooms and see if you have questions. We have about 10 minutes.